You're listening to Music Tectonics.
How to
start up.
Welcome back to Music Tectonics, where we go beneath the surface of music and tech. I'm your host, Dimitri Vitsa. I'm also the founder and CEO of Rock, Paper, Scissors, the PR and marketing firm that specializes in music, tech, and innovation. Today's episode is part of our How to Startup edition, and it's also part of our online event series, the Seismic Activity. So if you're listening in podcast land, check out the events at musictectonics.com so you can participate in a future edition. In just a few minutes, I'll be interviewing Bob Moczydlowsky, the former Managing Director of Techstars Music. But before we get started, I have a few announcements for you. The Music Tectonics Conference is back on the beach in Santa Monica, October 22nd to 24th. So please mark your calendars and get in touch with Shaylee Ankenbrook if you want to talk about an activation or sponsoring a panel. Also, super early bird tickets are going on sale April 23rd. This will be your first chance to sign up to be at the conference. Numbers will be limited, so be ready to jump on them and to get the best deal of the year. It really is a good deal. Podcast listeners, make sure you're getting the musictectonics.com newsletter for updates like this. And in other news, our next Seismic Activity online event will take place May 8th at 10 a.m. Pacific, 1 p.m. Eastern, and the topic is License to Generate. Is this music real? We'll focus on emerging technology to protect rights holders in the age of AI and derivative content. Those of you who are here, we just posted in the RSVP link, the chat. In the chat, we posted the RSVP link. So now to our guest. Bob Moczydlowsky started his career in 2003 as the founder of a small media consulting company producing content for the Sundance Film Festival and other cultural organizations. He then earned a Master's of Entertainment Management from Carnegie Mellon, where he now teaches digital media strategy. Soon after that, Bob moved to Yahoo Music, managing music information products during the site's run as the #1 web destination for music. In 2009, he went back to startup, serving as the SVP of Product and Marketing for Topspin Media. He then joined pre-IPO Twitter as head of music from 2013 to 2015, serving as the music industry's point person for commerce, music streaming, and video sharing features. Bob left Twitter to create the Techstars Music Accelerator, where he served as managing director from 2017 through 2023. Techstars Music was a global accelerator program that made 70 investments into media and entertainment startups and helped its portfolio raise more than $263 million in post-program funding. I'd like to welcome onto screen and onto the podcast, Bob Moczydlowsky. Hey, Bob.
Hi. Thank you very much for having me.
Thanks for being here. Yeah, awesome. And thanks all of you in our live audience for joining us as well. This will be fun. We'll have time for a Q&A at the end, but let's jump into this. Over the last 5 years, Bob, there have been a lot of changes in how music tech startups get funding and develop traction. And a lot of the tectonics community is curious about the role of accelerators, incubators, and even conferences in getting off the ground. Let's start top level. What did you learn about startups and accelerators by running Techstars Music?
Oh my goodness. Too many things, right? It's like it's the process of making investments is like nonstop learning from your mistakes. You get much faster and more visceral feedback from the mistakes than you do from the successes, right? So it really feels like it's nonstop failure all the time, and then 2 and 3, 4 years later you get some success. So the biggest thing I will say about this, and maybe this will sort of color our conversation a little bit, is that I think that the lesson I learned the most as an investor is really how to make investments. And so in a very sort of ironic way, running the accelerator for sort of 7 years and making the portfolio investments we did showed us a better way to make investments, I think. And I say that because in the live chat, there are actually some friends and mentors and people who are really involved in the accelerator. I see a bunch of familiar names. It's super cool to see them. There's actually a couple people on this call who, as investors in the accelerator fund itself, we were asking as we were making these investments, how do we make this bigger? How do we make this more helpful to founders in the category. So a lot of what I will say today is related to, I think, how we should be making investments in media entertainment rather than the way we have been making investments in media entertainment. And that's what I'm working on right now, is what the next thing sort of looks like.
Gotcha. So you're kind of in a unique position that you saw so many different kind of startups pass through the program, work with them, mentor them, and then help them seek out funding post Techstars music as well.
Right. Yeah. So and look, Techstars is great. Techstars is still a super vibrant platform. They're running accelerators all over the world. It's one of the original accelerators, started in 2007. The concept there is to try to get some early professional pre-seed funding, get your strategy ship-shape, figure out exactly what your market opportunity looks like and who would fund you and who are the right investors for you, and make as much progress as possible sort of in a 13-week or 90-day window, and then use the connections of that network and some validation there to go out and raise capital. And look, it works. Like, it works. We have a very vibrant portfolio. We've got some really valuable companies in it. We've raised more than $250 million for those companies post-program. There's a couple of them that are really important strategically in the way, music and media is working right now. We could talk about those at some point in the podcast. I don't mean to say any of this is like, hey, that's the wrong thing, or don't do it, or it's more of the reality of the accelerator model is that it was created in 2007, 2008, and kind of took off around the financial crisis, then when angel funding kind of dried up and it was really hard to get your initial sort of professional pre-seed investment. There weren't a lot of small party rounds. And so the concept of putting accelerators together to put that first sort of $120,000, $150,000 into the company and allow investors to watch it make progress for 2 or 3 months as diligence and validation, that really rocketed a bunch of companies into really valuable positions for people in the 2012-13 range, right? So 5 years later, the fruits of those investments sort of were ready to eat. And then now, if you fast forward, that model still works. The network is still valuable. The strategic insight and development you can get on your product and the feedback you can get is still really valuable. But the capital allocation is relatively small compared to the way what things cost now in 2024 versus what they cost in 2008, 2009, 2010. And the equity position that we're buying as an investor is pretty heavily discounted, right? We're buying a reasonable amount of equity for a small amount of money. That's part of why the value proposition works. You're taking risk on the baby company to do that. But into sort of today's market, founders need less sort of curriculum and more specialized connection and more capital. And so in general, I think there are still a lot of situations where the accelerator model works really well and can be helpful for people. But in general, I think there's probably a better way to do seed stage investing.
Gotcha. I want to ask you kind of a stupid question, then I want to get into a little bit more detail about what you're talking about.
Okay.
What's the difference between an accelerator and an incubator? Because when I got into music tech, I saw a bunch, in addition to Techstars, I saw a bunch of other things popping up, ranging from, project music and, some other ones that have popped up here and there. There was G Beta did some music stuff, and there was a Capital. Maybe that was the collaboration with Capital. There were just a few different ones, and I couldn't quite tell what the exact differences were. Can you just run down that in case they come back?
Yeah, happy to. Okay, so the most basic way to think about it is if something is an incubator, you are trading real estate or office space for equity. That's the easiest way to think about it. So if it's like, hey, we have an incubator, it means we have a house, we have an office, we have extra square footage. We bring some companies in, we don't charge them rent to be there. Maybe we introduce them to some people and create some sort of community, and there's some serendipity around people being around. But the basic economic deal is we're trading office space or real estate costs for equity. That's an incubator.
Okay.
An accelerator is we're going to make a cash investment. We're going to write a check and buy equity in this company, and we're going to provide office space and sort of a structured curriculum. Some people don't like the word curriculum. I think it's the best way to describe it. You're going to introduce them to mentors. You're going to run through a process. You're going to ask a bunch of questions. There are certain milestones along the way that you want to see these companies get through. But it's not a school. It's grow your business. but it's around like, hey, we've invested capital in this company. Yes, we're providing you a place to office out of and work, but we're really trying to move you into that next round of capital. And at the end of that, defined short amount of period of time, you're going to go out on your own and be a totally independent company and leave this office space and go out that way. So they really are two separate things. They get kind of used interchangeably because there are a bunch of other models, and I would warn people, if you are a founder, to avoid these other models. If the economic deal is not, I'm trading office space for a small amount of equity and you think that's a fair trade, or I'm investing in your company by writing a check and introducing you to people and putting you through milestones and trying to give you some validation for fundraising. If the model in between is like, hey, we come around and see us and we'll introduce you to people and you'll trade us equity. Like if I'm not getting a tangible thing that lowers my costs and grows my business, either actual capital into my business or saving me a real cost of building an office space and having a place to go and build the company, I would stay away. It's kind of a marker of a less professional founder and a lower grade opportunity to other investors. So other investors will look at companies that are in those sort of hybrid gray area models in between incubator and accelerator and look at them with skepticism around the decision making of the founder.
Good to know. Good pro tips from an investment perspective. You kind of sort of implied in your opening response that the accelerator model is not quite what's needed now, or maybe the type of accelerator might not be. What is the current state of accelerators? And let's get into just a tiny bit more detail about that before we move.
Let me qualify this with, I mean, in media and entertainment. Okay, cool. I'm not, if we're talking about climate tech, right? If we're talking about fintech, if we're talking about a geographically focused accelerator, as long as that accelerator is writing a check and buying equity in your company and also providing network and platform and validation and tangible value that you can see to help you grow your company, great. Those things work. You have to look at them on a cost benefit analysis basis as a founder. I'm not dissing accelerators, right? I think personally in media and entertainment, from a capital deployment perspective, there's a really big opportunity to make a bunch of money in and around media and entertainment from a venture perspective over the next sort of 5 to 10 years. I think there's a huge, awesome opportunity. And so my goal and why I'm saying what I'm saying is I would like to be, I want to capture as much of that opportunity as possible with an investment vehicle. The way to capture that is not with an accelerator. That's what I'm saying, just sort of specifically. And so the reason I'm saying this around media entertainment is that, and it's the only category I'm good at. Like, right, I'm not great at fintech investing. I'm not great at later stage investing. I'm not great at detailed financial diligence. I'm basically a talent scout. I'm good at, like, is this a problem? Could we solve this? How would the market react? Are these people credible? Can they build stuff? Do they make good decisions? And I can sort of convene people together. And I've been very blessed in my career that, I don't think anybody hates me. And so I can put people together in a room and convince them to try to help other people, right? That's been sort of the basics of it. So long-winded caveat at the top. What I really mean is that the better way to make investments in our category has to include solving for the follow-on capital risk problem. And the reason media and entertainment has a follow-on capital risk problem, meaning like who invests after the accelerator or who invests after the person who has conviction, is that investors like to see signal, and they like to see participation continuously from people who are in that category and are experts in that category. And what we don't really have in media entertainment at all right now is an entity that will write more than one check at any stage of the company. And so the accelerator is really good at giving founders that first little piece of capital, a little bit of validation, introduce them to people, help them get their strategy right. But then you actually kind of signal to the market that the company's got to, like, it gets shoved out of the nest and it's got to fly on its own. Whereas if you really believed in the category and the network and the opportunity there, you would keep writing checks into the companies that were succeeding that you had already funded once before. And that would send signal to other investors who might only make one or two media or entertainment related investments out of their whole portfolio or their fund, because their fund's not dedicated to the category. It's a more generalist, return driven fund. They need to be able to see that there's more capital to back that company and other checks to be there. So I'm saying that right now in that, like, every founder out there with an entertainment or media related startup should be very, in a very detailed way, digging in and thinking about who writes their first check, then who writes their second check, sort of at the seed stage level from a professional investor perspective, and then who might write their next two or three other checks. And if you can't sort of see that path through of like, okay, what fund do I match their thesis? Or here's my opportunity, and as my business gets this big, here's who's going to want to fund this. If you can't see that, you're missing out, and there's a bunch of investors who are going to pass on your deal and tell you your opportunity is too small or the TAM isn't big enough in your category. And it's because you weren't looking forward to show them that what it's going to be and tell them and point them to look in the right direction. And so just the accelerator enough isn't going to help. It's going to help you. It's going to be good. And I love doing it. And it was super rewarding. And we bought some great and valuable equity. But the amount of work I've had to do at the later stages for companies that are alumni of the accelerator has revealed to me that we're doing too much work with not enough capital deployed. And we need to change the way that model works so we can get better returns.
Gotcha. So my takeaway is startups need to be aware that it's not just eking out that first seed investment component to like get them to the next level so they can either take a paycheck or hire more developers or build more product, but they really need to have a strategy for a midterm, what's going to happen next, and that getting investment later is actually harder if your original investors aren't willing or able to reinvest.
Correct. And also, as a founder, you are spending your most valuable resource, your time and your effort, and probably some of your own personal capital in the prime of your career. And so founders need to be really objective about, is this opportunity I am trying to build and trying to fund, is it actually big enough and valuable enough and worth my own time and investment? Not just, can I convince someone to get me through the next year or the next 18 months, right? Investors don't fund companies to keep them alive or give them time and runway. They buy pieces of opportunities. And if you can't show someone that how big the opportunity is and what it is and try and sell them a piece of that opportunity, you probably shouldn't be working on the company either, right? If you can't pitch it that way.
Got it. Great. Some great questions coming in the chat. We're going to save most of those for the end, but there is a good follow-on from Joe too, from Sony Innovation Fund.
Joe.
Hey, Bob, how do you think about venture studios versus incubators and accelerators? Let's just throw a quick answer in there while we progress.
Joe's asking that question, I think, because we think about it from a corporate perspective, right? Like, could we make a venture studio where we say, here's the problems we want solved as an industry, and people come in there and there's some funding to solve these problems, versus, hey, we have a accelerator over here where you bring us your fully formed company ideas and we say yes or no and decide if we can help make those things work, and they go out and go that way. I'm going to contradict almost all the other things I normally say, in that, like, I actually kind of like the venture studio idea. It's sort of fallen out of fashion. I think there's a couple of venture studios in the world that do this in a really good way. The venture studio model is, for people who don't understand, is you bring your concept in and the studio provides product development and design and staffing and office space and some capital to help you build the concept, and they take a very large amount of equity as a result. They basically become co-founders with you of that product. Liquid Death, everybody knows Liquid Death, the water brand that you see at music festivals and sporting events, whatever. That is a venture studio product. Dollar Shave Club is a venture studio product. Both of them out of the same studio, actually, here in Los Angeles. I think Pioneer Square Labs, that's basically funded by Amazon in Seattle, they've done some really great work in their venture studio. So I think there are, if you are building a consumer product that needs a ton of money and a ton of traction immediately, right? The investor sort of slang for this would be like a bottle rocket, meaning you get to light it one time. And if it takes off and makes something beautiful in the sky really quickly, it's success. Otherwise, it's a dud and it fizzes out and it's over. But you only get to light it once. And so if your business idea is a bottle rocket that requires really fast, well capitalized, like let's go do this thing immediately, and it's a consumer product, not a business to business product, not a hard tech product, not something that takes years and years to drive adoption, but something that just goes immediately, I can kind of get convinced that the studio model might be a good way to do it. So
Got it.
that
Cool.
it's a great point that Joe brings up. It is sort of the third credible path. There's the incubator. I trade my equity for real estate. The accelerator, someone writes a check and helps build me. And then the studio is I partner with the studio to build the company.
Got it. Great. So I want to get some. We talked about kind of the supply side of investment.
Mm-hmm.
We can talk about the demand side a little bit. From your days with Techstars Music, what are some examples of startups that did investment well? And if you also want to share some that didn't well, you don't have to reveal names, but sort of give us a little specificity around, like, as you know, startups that are here listening to this today can get a sense of, like, what are some pathways that worked for specific companies?
Well, probably the most helpful thing I could say in that category, in that question, is like within my portfolio, there's a category of the most valuable companies, and there are things that these companies have in common that are very obvious to see. And some of them are not super big or really valuable. They're still relatively small, right? They're in the $20-30 million value range, but their founders operate and look at these things sort of in the same way, and that is that. The biggest thing that the most successful founders in my portfolio have in common is that they are running their business with a spreadsheet, and they're looking at it going, if I spend this amount of money on dev, supplies, marketing, whatever, I get back this much revenue. And there's only one company in my portfolio that thinks in terms of, if I spend this much money, what I get back is not revenue, but is users and usage and engagement. And the company has been continuously funded based on the size and volume of that engagement. And where it was just a very like 2008, 2009, 2010 venture approach, which is like, hey, if we can just get to 150 million users, it doesn't matter if we make any money. No company that ever got to 150 million monthly active users went unmonetized or unsold. Those are super valuable properties. Let's just do that and get that big. And out of 70 investments, I have one of those. All of the rest of them manage their business with how many dollars do I spend to get more dollars in revenue? And the best ones, of which there are 2 or 3 that are profitable inside of that portfolio, who have realized that they thought they could get to $100 million or $200 million in annual revenue, which would yield venture size sort of valuations, and they can't. They're stuck. They're like, okay, well, this is probably just going to be a $25 to $50 million annual revenue company. They immediately realized that and stopped pitching venture investors and stopped spending their time trying to get venture investors to fund the company, because even they could see there's no way someone's getting a 10x multiple on their $2 million investment in this company, right? Or a 100x multiple on that. And so the thing that founders really have to think about in this structure is, if you're pitching an investor, so let's say I had a $50 million fund and you came to me and wanted investment in your company, and you should know how big my fund is. I've got $50 million I'm investing. You should also know that I have to evaluate every single investment I make as if it needs to return all $50 million of my fund. Right? I'm looking at you going, if I write you a check, I have to believe that all the other investments I'm going to make are going to go to zero. And you're going to return all of the money that I've invested. Right? So I need to get at least $50 million back from you. But in reality, what I need to see is that you're going to return the fund. And by return the fund, what I mean is you're going to get me into profit. So I need to make $3. I need 3x on top of that, right? So if I write you a $5 million check, I need to believe that my $5 million check into your company could be worth $150 million in returns. Okay, whoa, right?
That's a big number.
That's a big number. That's a lot, right? Yeah. And that's the way the investors are thinking about it. And so if you start thinking this way as a founder, you can then sell me the thing I am trying to buy, right? I'm trying to buy a piece of an opportunity that's going to be worth that much money in the future.
Yeah.
So sell it to me that way, right? And the thing that these founders that I have in common in my portfolio, and I think to the gist of what your question is how do founders do this? What's like, if the founder's not looking at a spreadsheet going, hey, if I lose $10 million over the next 5 years, I'll be in a position where I have this many users, I can start making $75 million a year. And then from $75 million a year, I can go to $150 million a year. And then next thing you know, this thing is worth $800-900 billion on the valuation of the company. And if a founder just explaining that in really simple, practical language is really compelling. It's not about like, oh, we got to get $5 million together so we can build a team. It's like, dude, you should have already thought about who the team is.
Yeah, cool. So as I was talking to our chief strategy officer, Tristra Neyer-Yeager at Rock, Paper, Scissors about this topic, I think it was her, she referred to this conversation about accelerators and incubators and conferences and competitions as the startup circus.
Yeah.
We've seen a lot of startups, get a lot of visibility through kind of activating through these types of things. I'm curious to ask you, what about conferences and competitions? I know this is a totally different direction than where we just were on the last answer, but how should startups be thinking about those in their roadmap and path to traction?
They shouldn't be. Build your product. In my opinion, like, listen, you run a really good and valuable conference, and people who have startups should only be at your conference if they're going for a specific reason. And the specific reason is there is a person at that conference that they need to do business with. If they are going to the conference to pitch the company or to get awareness for the company or to win the pitch competition so investors will think we're interesting, they should stay home and work on their product. If they can go to the conference and demo the product, and in addition to having a one-on-one meeting that they know is 100% for sure going to happen with the person who they need to meet with, right? I'll pick on Joe because he's in the chat and he's delightful. If you know that Joe is a Series A to Series B level $2 to $5 million co-investment check investor, which he is, and you have a round that is 40 to 50 or 60% committed, and you have a lead and you know that there's a strategic reason why you would want the Sony Innovation Fund to write a check into your company and why you want to do business with Sony, you're an idiot if you don't buy an early bird ticket to Music Tectonics and go to the conference. And in the meantime, ask Joe to we can take a walk down the beach and talk to him about your business, right? But
cool.
if you're trying to just meet Joe and pitch him to lead your round as a seed investor, which he isn't, right? And be the lead, which he isn't, right? What are you doing? Yeah. These are known things, right? Like, these are things that you like. And so in the whole startup circus around the world, pitch competitions, this conference, whatever, all of them should be a means to an end. And if you can't tell me specifically what the means to an end is, you should stay home and build your product.
I have to say, it's very hard to recruit the kinds of people we get at the conference, and Joe's one of them.
That's what I mean. Yeah, like, your conference is great, but it's great because people can go there and do business.
Yeah,
you can't go there and build awareness or build your brand or be seen or like you're wasting your time and money. And right, to be honest, you're providing a negative signal to investors who know what they're looking at.
We also try to bring in potential partners, record labels, managers, agents, things like that too, who are sometimes beta users for music tech companies. And then there's the carousel where we have demos where investors can quietly go around and actually just check out, get a point A on sort of like, what is this company up to? Should I keep an eye on them? Kind of stuff like that. But I think it's a healthy dose of realism about what expectations you can get out of something.
I mean, look, you should have the same expectations that people there. You should be saying the same thing, right? And like, it's expensive to come to Music Tectonics. It's not relatively expensive, right? But it's in time and effort. You spend a lot of time and effort putting a really good group of people together. That really good group of people is there to do real work. And so if you can't come and do real work, go home, do this thing, come back next year, right? Like that. And if you need to learn what real work looks like, come and watch and lurk and pay attention and note and watch what happens, right? And that's a totally different thing. But in general, you see founders traveling around the planet, going from conference to conference to conference, and pitch, and it's just like, or when do we work on the company?
Right. Yeah. Got it. So I got my takeaway, guys, is come to Music Tectonics, and that's the only conference you need to come to. Anyway, let's widen out a little bit. How's the music tech investment market looking in 2024? You've kind of like touched on that a little bit. What types of entities are investing? What kind of trends are changing in investment, et cetera?
Well, so right now, if someone knows, I don't know everything, and I'm not like, please correct me in the chat, but I am unaware of an entity that will write more than one or two checks around media and entertainment. And I keep saying media, you keep saying music, and I keep saying media and entertainment, and that's not an accident. I don't like music is a subset of media and entertainment, right? I think about my investment thesis as investing in companies building the future of entertainment, live events, and self-expression. No music, right? If those companies happen to change the way the music business works, or are beneficial for music, or are related to music, great, that's cool, right? But I have always made investments around future of entertainment, live events, and self-expression. And these are companies that if they succeed, the music business would benefit, which is why I had capital from the music business, right? Music capital came from the music business to me to go invest in startups. Dirty secret and not so secret of Techstars Music is we didn't invest in that many pure music companies, right? The most popular and biggest pure music company, and I could even argue it's not a pure music company, is Endo, right? It's a functional music company. It's an AI soundscapes company. It is also a personal health and wellness company, right? So I keep saying it that way because there are a lot of funds who will write one or two checks that are related to media, entertainment, live events as part of their broader portfolio and thesis. But I am unaware of a fund that has that as their sole focus. And so the prospects for media entertainment companies raising capital right now in this current market are not very good. It's tough, right? Because what you have to do is find the investor who's looking for you, and there's no regular set of places to go. And if I'm a seed investor, a generalist seed investor, or a generalist Series A investor, I'm looking for signal below me. And what I mean by that is I want to see really good angels writing checks. I want to see really good pre-seed investors writing checks. And then I want to see, like I mentioned earlier, I want to see those investors continue to back the company and take their pro rata and invest in the business and grow it. And that entity doesn't exist right now.
Darn.
I'm working on it.
Yeah. Okay. All right.
But my point is like, so if you're a company in this category, it's tough. And so what you have to do is realize that you can't just go get the Midas list of VCs or a bunch of famous investors and hope that you're going to pitch them and they're going to be persuaded to invest in your company. What you have to do is do a bunch of really deep homework, and you need to be able to identify and talk about investors the way I just talked about Joe, right? Now, we'll keep picking on Joe for the sake of the podcast, right? Sony Innovation Fund is a corporate venture fund. They have outside capital, but like they use their position to benefit Sony and their investors. And a lot of the stuff they invest in sort of has to have a strategic benefit. Like if it wins, Sony wins, or it helps Sony accomplish something, or there's a reason why they would back it, or it replaces a business unit or challenges them in some way, right? But they're primarily co-investors, and they want to be with other good investors. And so there's a lot of people who are like, oh, well, I could go get the labels to invest in me, or a manager to invest in me, or I could go pitch the corporate venture fund. But there isn't really a signifying fund that if I'm a grade A venture fund in New York or Boston or the Bay Area, that I look at it and go, oh, that's Signal, that's a grade A deal. There's lots of co-investment money, but there's not a lot of lead money. And you as a founder have to figure out where that's going to come from.
Let's widen out on the other side. What trends do you think have legs and the most potential for the media and entertainment space?
There you go. It's dangerous to be a trend spotter, right? It's dangerous business. The way I will answer this is to say that I think we are at the end of a really amazing era that I will call streaming 1.0, right? And in streaming 1.0, the goal, if you really oversimplified everything, was make all the media play. Give me access to all of the media all of the time, where I want it, when I want it, how I want it, at a reasonable, convenient price, and make it work on my phone, on my laptop, on my TV, in my car, everywhere. Just make all the media play. Make the media play. That's streaming 1.0. And if you look at growth rates for subscriptions, if you look at engagement rates, if you look at it feels like we're pretty mature at this point, right? We have we have really good streaming fitness stuff. We have really good streaming video stuff. We have incredible streaming audio and music stuff. Everything kind of works, and those are all pretty good sized businesses, but they're growing a little less than they have been, right? The curve is not quite as steep as it used to be. And I think that puts us we're about to be at the beginning of streaming 2.0. And my version of streaming 2.0 is, instead of make all the media play, it is to play with all of the music. It is to allow me to have experiences that I'm in control of, where I manipulate the music, I combine it, I change who the singer is, right? I move around the genres, I make stuff myself. I generate media that I need, that I use for my own personal work. All of these things I would lump into the bucket of play with the music or play with the media, right? So in that way, I think there's a bunch of things that are going to show us different user experiences, and people are going to tell us what the products could be. The fan and the consumer is going to tell us what the products can be. But we're in this really wild and I'm crazy optimistic. It's going to be really awesome for the next decade, because we really are in the digital natives controlling the world part of the story. It's not just convert your library into streaming and organize it and charge me $10 to access it. It's going to be, hey, I can generate songs with an idea and a verbal prompt, right, to an AI engine or to a model. Great. Now we have even more songs, right? What business is now possible because we can do that? What video game experience can we create because we have unlimited access to, music or media or visuals? What storytelling opportunities, what self-expression opportunities are there? And that's the way I think, that's the way I'm thinking about it. And that's the way I think investors are looking at the next sort of 10 years is, if you let people play with the media, what are the new experiences and new products that we can create?
Awesome. Great. I have more questions for you, but I'm really digging a lot of the questions that are in the chat. So I might just read some of those out to you. And then
totally.
if there's more questions, we can even bring folks on mic. Ivan Todorov asks, do you see founder investment requirements going down significantly as they leverage AI to build their apps, content, and experiences? Is there a world of one-person billion-dollar media properties and companies?
I mean, I think there are definitely going to be. I think there are definitely going to be really valuable, larger 2-3 developers, one person. I use a bunch of democratized tools, sort of thing, that are wildly profitable. Yes, I think we have a crazy, weird story that I'm not an expert in antitrust. I follow it professionally because of we have the EU and the US having a pretty chilling effect on startup acquisitions and liquidity events and people buying things and other products, right? We have big tech getting bigger every day, and we have it getting harder and harder for small companies to compete and for startups to get liquid and move out. They're really like the I'm going to sell the company to a larger platform company era is pretty frozen. Like it's that era seems like it's over. And so I do think that there will be the ability for 3 or 4 really talented people to build a product and keep it private and not have to raise outside capital and grow it with revenue. I think the ceiling for those businesses has never been higher. I think it's totally possible that you could have people making $40, $50, $60 million a year on those businesses. I also think there are just the real opportunities that investors are looking at are going to require upfront capital and really high quality teams. And really high quality teams have never been more expensive. And so I think that's the counterweight to that reality.
Got it. We've got another good question here from Donnie Canner. Acquisition seems to be the main exit for media tech. In what part of the music industry is there space for a unicorn that might go public? how can music be the business?
I mean, come on, man. If I knew the answer to that, I'd be out there hounding that founder and writing checks. That's the goal, right? I believe there is like I wouldn't be doing what I do, and I wouldn't have the position that I have if I didn't believe that that was the case all the time. So I absolutely think I think there's more than one opportunity for a publicly traded, gigantic unicorn style entertainment, live events, self-expression company. And I'm not trying to duck the question, but I kind of already said what I think it is, right? I think it is a thing that allows you to play with the media. I think it could look like a game. I think it could look like a social platform. I think it could look like an entertainment or a television experience. Like I don't think it's limited to any of those categories, but I think the thing that's required inside of it is give fans all the freedom to manipulate the media in a totally different way. And maybe that means you're going around the way IP works now, and you're generating all of the media so that you can control both sides of it, or generate all of the media so it's totally owned and operated by the entity. Maybe that's what's required for that to happen. I think there probably is one that's like that, but I don't necessarily think that it has to be that for it to get that big. But yeah, I definitely think there's room for it. Give kids control, I think, is where the money is.
Got it. Cool. These questions are great. So I'm just going to keep going, and your responses are super helpful to hear. William Gary asks, why do investors only write one check if they own equity? Are they more likely to want to just have ownership of the business rather than pour additional money into after the initial funding?
Okay, so great question. I'm making those comments specifically to venture investors, where you are taking a minority position in the company. You have some control with a board seat, and you have some information rights, or you actually have some voting power or control over the staff of the company. I am not that investor. I make passive investments. I'm sort of servant, and my equity eventually gets diluted because other investors come inside. So the thing that investors will look for, venture investors, not private equity investors or people who want to own the company. Those are a different category, different kind of investing. Those investors are really focused on profitable businesses that can either be optimized by cutting costs to make more profit, or be grown with investment to make more profit and bigger revenues. We're talking about loss-making private companies that have just started up that are not yet to that stage. And so the judgment call that investors are making is this company making enough progress? Is the execution good? Is the team healthy? Are we hitting milestones? Even though at these milestones we are thrilled to be hitting, we are still losing money, but we are losing less money on overall basis. Maybe our unit economics are now positive, but our overall overhead is too high. But we're growing enough that we believe we're going to get to the place where our revenues are $100 million plus annually, or we have 100 million users plus on the consumer side. And so everybody's making a judgment call in those cases. You're guessing, right? You're doing as much research and diligence as you can. You're interviewing the team. You're playing with the product. You're checking everything you can, but you're really making an educated guess as that whether this thing moves forward. Well, a very practical way to make a better educated guess is to go, well, the people who have already invested in the company, who have been helping it and watching it for the last 2 years, are they still writing checks into the company? Are they still putting capital against it and funding the opportunity? Or are they sitting back on their hands waiting for someone else new to come in and put capital in? These things have a social effect. Like, capital's not rational, it's emotional. And in that moment, if the people who have been funding it for 2 years are still funding it, it sends a message to the downstream people that this is something that's valuable and worth having. And if the insiders are not funding it, I want to know why. Oh, well, the CEO is a little squirrely. The company's making good progress, but we don't really trust him. Oh, well, that would have a chilling effect on my willingness to write a check. So that's why I talk about it that way. And I think that signal is both positive and negative for the founders, right? So the founders sometimes are like, well, I'm just stuck. I need help. We got to get through this channel, and my investors won't back me and keep me going. Those are all the human tensions involved. But the next check writer wants to know that the existing shareholders are participating.
Yeah. Super interesting. There's psychology of investors that we're hearing from you. It's super interesting as well.
Look, man, like, it is not rational by any means. Yeah, it's humans.
Here's another great question from Eddie Miklovich. Do you think venture-backed startups can realistically help more artists create sustainable careers? Or do the demands that naturally come with venture investments, such as become bigger than the music market, return 100 times return, make it difficult to stay mission aligned in the long run? I like the question because we see a lot of music tech startups that are here to help to fix things for the artist, fix things for the industry. So it's interesting to hear whether those types of startups are already kind of a mismatch for the kind of funding you're talking about.
They are. If the artist is your customer, it's probably not a venture opportunity. And there are examples of that where you can counter that. I'm not saying black or white, but I'm saying the easy position from a founder's perspective is, hey, there's not that many artists. There's a whole vast solution of source, section of them or whatever that are going to fail, that are aspirational. And the handful that are going to make it inside of there, they're not going to pay. You're going to have to pay them. And they don't act as a block, as a rational group of things that move around. They're all self-motivated individuals, and there just aren't enough of them compared to the consumer side or the fan side. So if your startup is tools for artists, it could still be a good business. You still could make money doing it. You still could have a really rewarding and awesome life. You should just look to a different kind of investor, and think about how you run that business, from your boat in the Caribbean, rather than run that business, where the demands of the capital are, we get to $100 million in annual revenue.
Gotcha. Are you cool with this? I got a couple more good questions.
Let's go.
Yeah, this is great questions to our audience too. Love the Music Tectonics listeners because these are like in depth. Kalman Chodakiewicz, hope I got that right, says, with the likes of major money generating tours like Taylor Swift in 2023, how are investors weighing future live event, live media entertainment investment opportunities as opposed to investments around home media manipulation via Gen AI tools like Suno.ai, ChatGPT, etc.?
Okay, so there's using anything involving Taylor is dangerous business because she's Taylor Swift. She's their own thing, right? She's a sort of cultural phenomenon. That said, the live events thing is interesting to investors because it has built-in scarcity. If you could figure out a thing that works in that setup, like the demand for those experiences in a world where we're all on screens and we're all remote and whatever, like the visceral in-person event has become really desired, right? I mean, it's not a secret what's happened to prices of attending live events. Like the prices have never been higher, right? And it's because there's enough people to go. And so the more people want to go, the higher the price goes because it's limited, it's scarce. There's only so many seats. There's only so many tickets to get in the building. That said, because their demand has been so high and prices have been so high, there's been very little innovation in what actually happens inside of a live event. Like even at Taylor's show, there's 100,000 people there that have supercomputers in their pockets. How do they play with the music? How do they play with the media and the entertainment, right? Like, how are they interacting? And like, there's all of the things that have happened in terms of audience interaction and inclusion or whatever have been gimmicky, in my opinion, to this point. But if you think about it from a sports perspective, rather than from a music or a concert perspective, you can see where the opportunities are a little easier, right? Like if anybody on here is lucky enough or wealthy enough to be a season ticket holder for a professional sports team, I am not. I wish I was. I would love to be a Dodgers season ticket holder, but that isn't happening. If you're in that experience, you are paying the maximum price to be there. You're bringing friends in. The people you're bringing with you are really valuable to the team. They're incredibly potential, high level potential customers. You're buying food there all the time. You probably have gear and merch. You're probably attending playoff games and doing all these other things, right? So, but your revenue potential is basically maxed until your experience becomes personalized. Well, I have to know your identity to personalize your experience. And I have to have really good software, and I have to have really good dynamic pricing and opportunities and marketing stuff in order to prioritize and greet you by name and give you different experience and different product offerings and figure out when I offer you the opportunity to run on the field or get your autograph from your favorite player or whatever it is that are upsells and more revenue, that we're at a point basically in live entertainment where the revenue is stuck against the ceiling until we can personalize those experiences. And there's a lot of software required for that to happen.
Nice. I've got a question for you. This one comes from me, Dimitri.
Let's go.
You had talked about at the beginning how you don't define things around music tech, and actually a lot of your investments at Techstars Music weren't all directly music per se.
Yeah, community, replica, Hello Tickets. There's a long list.
Right. Yeah. But I am curious to hear from you what other industries or verticals you're keeping an eye on, parallel universes of music for your own learning, or verticals that have the biggest potential partner potential with the media tech and entertainment stuff you're looking at as well, just to get what is Bob kind of pulse checking these days to for the larger media folks to think about.
So I said this to a friend of mine the other day and he thought I was crazy, but I think we're at a moment where entertainment is just one category. There's no more verticals inside of it, and the product mix is just varies based on whatever the entity is. And the example I was using is like LeBron James and Lil Yachty, right? LeBron and Lil Yachty both have podcasts. They both have video production teams. They both have merchandise and logos and fashion lines, and right. LeBron gets paid to play basketball. Lil Yachty, has recorded music income, right? So LeBron's recorded music income is zero. Lil Yachty's basketball income is zero. But out of the 100%, the other 100 available points of where their income comes from, there's a lot of crossover. There's documentaries, there's television appearances, there's name, image, and likeness. There's right. So I feel like we're in an era where if you are an entity that people pay attention to, you're all kind of the same. You're all kind of in the same vertical. And I think you can see the classic entertainment companies starting to operate this way, right? Casey Wasserman, who, if you don't follow, you should. He's really amazing, thoughtful guy. He's running the Olympics for LA. He runs the Wasserman Agency. They own Paradigm and a bunch of other booking agencies. They sort of built their business in like alternative sports. They would do skateboarders and action sports athletes and bikers and all that sort of stuff. They bought a television production company so that they would have those capabilities for their entities. And for a long time, I think publicly, he would say, we're not going to get into traditional media production. And then yet when it became time to realize that we need those capabilities, quickly changed course and bought Brill City Entertainment. So you can see these things start to happen where it's like, what vertical is he in? He's in entertainment. It's all entertainment. And inside of entertainment, there's live events, there's stuff on screens, there's stuff you pay to go see in person and ticketed stuff. There's fashion and merchandise and products, all kind of converged into entertainment, in my opinion. And then when you add the self-expression part, that's the combination of a bunch of kids wanting to become those entities. How do I become one of those entities that people pay attention to? That's a whole category too of like, I'm now having these experiences where I'm participating in that as an equal player. Obviously, some people collect more attention than others, but the reality is like, it's kind of a level playing field for the most part.
So in a way, you're talking about the same types of tools for leveling up in the creator economy apply to celebrities, athletes, musics, artists, etc. And so that's kind of the field that you see it in, is sort of like that chutes and ladders of getting up there. But regardless of whether they're grassroots or major label or, major sports team or whatever, what are all the things around that?
Yeah. I mean, it's like Lil Yachty is study Lil Yachty. Dude is the best. He's the best. Got it all. He's confident in the gaming environment and the gaming experience. He's confident in the music experience. He's confident in the fashion. Action Bronson is a good one going by in the chat. Also, I mean, Lil Yachty's at a different level than Action Bronson, but like the way to put it, like I think these things are there. There are examples of people who are showing you that it's just one thing.
Yeah. Great. Awesome. Well, this has been incredible. Bob Moz, thank you so much for joining us. Can't wait to see what you do next. Hopefully we'll have you out at the conference this year or sometime soon again.
Plan on it.
And really appreciate you taking the time.
I mean, listen, let me plug your conference really quick. If the if the conference has half of the quality of the discussion that I'm watching go by in the Zoom chat really fast, and we're pulling questions out of there, like, it's worth it, right? Get there. But this is high quality stuff. There's not a lot of folks that think and talk this way. Be friends with each other, talk to each other, share ideas, help each other. There's no other way to move it forward. So
Awesome.
Thanks for having me, and thanks for doing what you do. It's very cool.
Will you be at Music Biz this May? Some of my team is hitting the ground in Nashville, and I'm leading a music tech meetup. Meet the movers and shakers of music, tech, and innovation will be taking place on Wednesday, May 15th at 1 p.m. in the JW Marriott, Room Griffin FGH. That's the community hub. Join me and other music industry innovators to meet, share ideas, and learn from one another. Come ready to expand your network or make a friend. See you in Nashville.
Thanks for listening to Music Tectonics. If you like what you hear, please subscribe on your favorite podcast app. We have new episodes for you every week. Did you know we do free monthly online events that you, our lovely podcast listeners, can join? Find out more at musictectonics.com. And while you're there, look for the latest about our annual conference and sign up for our newsletter to get updates. Everything we do explores the seismic shifts that shake up music and technology, the way the Earth's tectonic plates cause quakes and make mountains. Connect with Music Tectonics on Twitter, Instagram, and LinkedIn. That's my favorite platform. Connect with me, Dimitri Vitsa, if you can spell it. We'll be back again next week, if not sooner.
You're listening to Music Tectonics.